Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for July 19th of 2021. Please see our disclaimer for important information. Well, as we take a look at our high frequency data for the week, the data is actually improved from our prior analysis last week, and as you look down the column, which has changed month over month, you can see a clear uptrend in a lot of the key data. Now, if you look in the column just to the left of that, the change relative to 2019, you can still see we're still about 26% down in global commercial flights, about 22% down in TSA checkpoint data, although that gap is definitely narrowing. Open table, restaurant industry reservations down about 8%, but you can see all of those categories are emerging, and the month over month data is really positive, and even over the last week as well. And so some of the more industrial type indicators, rail car traffic, steel production, still positive. I think we're seeing continued good trends on the manufacturing side and on distribution, even if shipping rates are going up considerably. Here's a quick snapshot of several of those indicators. So for those of you who are a little bit more visual, you can see hotel occupancy trending up. We're broaching that 2019 line. Open table, you can see we're well above last year, trending kind of close to where we were right before the pandemic set, and we're kind of like holding in a pattern right there, but clearly an improvement year to date, as well as the TSA checkpoint data and motor gasoline sales. You can see that they're actually above 2019, and that has a lot to do with the emergence of interest in travel and getting out after having been cooped up for a while. Here's on the left-hand side, you can see the leading economic index, the LEI. It's a series of indicators that encompasses a fairly broad basket, and you can see that we've actually recovered, more than recovered, our losses from the pandemic, and we're actually in excess of where the indicator was pre-pandemic. So we always look at signals in the LEI to kind of tell us maybe where these inflection points are going to be and where things are going to begin to bog down, and clearly they're moving up in a fairly high manner. On the right-hand side, we have the Institute for Supply Management Manufacturing Index, as well as a non-manufacturing index, or in other words, a service index, which frankly has a much larger weight on our economy. You can see both of those are trailing higher. You see that extra shade along the 50 gradient there. These indices are diffusion indices. So what that means is any reading above 50, as I've said in Charts of the Week and Market Minutes here in the last several weeks, indicates expansion, and anything above 60 indicates very strong expansion. And so when we look at these indicators, particularly over the last few months, we've had a little bit of gyrations, and even though there's some introspection over the fact that maybe some of these indicators more recently have fallen slightly short of expectations, you can see here clearly that they're well above the 50 break even or neutral growth point. They're still in expansion mode, well into expansion mode, and the trend line is definitely higher. This is a quick look on inflation, and I saw this chart in a Charles Schwab piece, and I thought it was really, really good because it shows you points in time dating back, frankly, pre-World War I, where inflation has spiked, and it kind of puts us in today's terms kind of relative to what those other peaks have been. You can see that we've experienced tremendous CPI, Consumer Price Index, numbers at various points in time. Obviously, wars and Great Depression would tend to move that needle the other way. Great moderation, which, frankly, if you look at 1990, well, you can even go back to 1980 when, or the early 80s when Fed Chairman Volcker had an all-out assault on inflation, raised rates, brought the economy screeching to a halt that kind of ended that era of these, these pronounced swings in inflation. You can see, over the Great Moderation, how inflation has really kind of trended down. And so this burst of inflation that we're talking about now, while it's not insignificant in relative terms, it's not a major aberration, like some of these other dislocated points are. Here's a chart, and we'll look at non-farm payrolls. That's that light blue in the upper left, and then we've got unemployment rate, which is just below that. So we know what the trends are, and the trends are continuing to hold fast. Again, there's really no, material, moderation. I mean, we just continue to see progress in the labor market, despite the fact that there are choke points in hiring. We know that there's a high quit rate, a high job opening rate. Some people are having a lot of people, frankly, are having lots of trouble hiring talent, and that has more of perhaps a social dynamic, mobility dynamic, and frankly, a philosophical element to it. But clearly the trends in labor are positive. So jobless claims, you can see on the upper right, again, it's relative. You got that huge outlier, which was due to the pandemic and the shutdown, but those numbers continue to come down as well. Now, on the lower right-hand side, we'll talk here just a second about the National Federation of Independent Business. This is a small business advocacy group, NFIB, and their hiring plans. You can see here, this is really important, at least as far as I'm concerned, because this is the intention to want to hire. And obviously, if you have the intention to want to hire, you have to feel fairly confident about your business and your prospects, and you can see that those indicators are trending higher here. What we're looking at now on the left-hand side is a plot of the National Federation of Independent Business, like we were just talking about, NFIB, Small Business Capital Expenditure Plans. And so that's in the darker blue, and then the lighter blue represents non-residential domestic investment. And you can see that we've had some fits and starts in CapEx, capital spending plans. Again, this kind of goes back to hiring. So you wouldn't be planning to spend money to expand your business, to add infrastructure within your business if you didn't feel relatively confident about your prospects. And so while those indicators have struggled a bit, even post-pandemic first wave, when we saw the second wave, those indicators were still relatively weak, but they've popped back up, and as well as the domestic non-resi domestic investment number in that light blue too. So those two are trending positive, gives me some optimism, cause for optimism here. And then speaking of optimism, on the right-hand side represents the consumer and how they feel about things. So the Conference Board has a consumer confidence index, and that is in that dark blue on the right-hand side. And then in the light blue represents retail sales, and it backs out autos, which have been obviously extremely noisy as of late. But if you look at those, I mean, the consumer is feeling confident. Consumer represents 2/3 of the economy or greater. And so if the consumer is confident, and this also is an indicator that kind of feeds into the leading economic indicator index that we just looked at. So again, these are relatively positive numbers. Here's a mosaic of some housing data, and just kind of bring you up to speed. Again, I've read through a Charles Schwab piece that I thought was phenomenal over the last week, and it puts a lot of this in graphical form, and I thought it was just too good to pass up sharing. So you look in the upper left-hand side, that's existing single-family home sales, and we saw a spike post-pandemic. That number has come down, and these represents millions of units. A lot of this has to do with prices, not so much from availability of credit, because housing affordability, as you look directly across from that in the upper right, you can see if housing affordability is not terribly adversely impacted. I was worried about that when we saw interest rates begin to move higher, but we know that housing prices are going up, but overall affordability has not been terribly impacted because rates are so low. In fact, we've seen a kind of a retrenching, if you will, of 30-year and 15 and 30-year fixed rate mortgage rates. Home prices, which is represented in the Case-Shiller in the lower right, you can still see that number going up. Again, I don't think the rate of gain is sustainable, but clearly, as you can see, dating back to the beginning of this century, you can see that we have had bouts where home prices have gone up and accelerated by a pronounced rate. So this is not the only time that's done it. It's getting a lot of press, but I do think that there's a rate of gain change in the offing, just because we're dealing with the law of large numbers, even though supply and demand is fairly tight. And then finally, on the lower left, as I was alluding to, we continue to see 15 and 30-year mortgage rates continue to slide down, which helps to support that affordability index, even if prices are moving higher, and we're beginning to see a little bit of a rolling over in home sales here as of late. This gets into shipping on this page, and just to underscore a lot of the cost inflation that's embedded in the production sector, and some of this relates to logistics and getting products to the marketplace. You can see both of these charts really tell the same story. Now, the left-hand side represents freight coming out of China. That's moving considerably higher. This is an index. It just represents that there's cost in inflation in the shipping market coming out of China. And then the right-hand side actually represents, in very direct terms, the spot rates for 40-foot shipping containers from China. And these things are hitting new highs right now. So obviously, this is something that we worry about being passed along to the consumer because it may not be the manufacturers that are dealing with this part of it, but certainly getting product to market and getting retailers stocked is going to be impacted by this. This is the U.S. dollar index, and you can see the gyrations in the dollar going back to roughly 1970, and we've relative to post global financial crisis and even post tech bubble, we've seen a kind of a secular decline in dollar in the dollar index, and it did perk back up about the middle part of the last decade, but as you can see, we're kind of moving in a channel. So I want to caution against maybe fears of some pronounced change in the dollar, just because the data doesn't necessarily support it. And what we're dealing with here is upwards of 10% swings either way, and perhaps the dollar has been weak as of late, because that there's really no current inertia on raising interest rates by the Fed. And in fact, they've been fairly stubborn. But I do think the possibility of that calculus changing in the coming months, if we continue to see high inflation numbers persist, then there's going to be an awful lot of pressure to raise rates, which, if rates were to move higher in the U.S., which are already in relative terms higher than in many points of the world, and also recognizing that many other central banks are already raising their rates, that could add some strength to the dollar. Here's a quick look at gold. Gold has been quite volatile lately, not nearly as volatile as Bitcoin, but nevertheless, it has moved around a bit. And we're seeing some strength in gold, and some of this has to do with the inflationary numbers that we're seeing. Again, it's trading in a channel, so I don't want to get too carried away with what one might view as optimism towards gold. Obviously, if inflation persists, I would expect gold to kind of catch a bid and continue to move higher, perhaps back up to that 1900 level. But you can see the range here. Here's a quick look at crude oil stocks. And so, we've had some rhetoric here over the last week about perhaps more oil being loosened up out of OPEC and OPEC plus. This represents crude oil stocks. You can see that in this 5-year range, as we look at this time of the year, we're on the low end, and you do see production picking up a little bit, but as I've shown in prior weeks, it's not picking up at an accelerated pace, even though we're over $70 a barrel in crude. We have seen crude prices kind of roll over just a little bit, but clearly here this seems to indicate not only crude usage, but also distillates and gasoline usage we saw earlier was very high. This is a quick look at some of the other commodities that I think are important to all of us. And if you look on the left-hand side, this is the CRB Raw Industrials Index. And you can see that the trend line is still very positive, very starkly upwardly sloping with no real break necessarily in the data. On the right-hand side, you can see the percentage gains over the last 12 months for a lot of the key agricultural commodities. And so when you think about the backdrop of we just had two readings of close to 5% annualized consumer price inflation. And then you look at these data. I mean, soybean oil up 120% year over year, ethanol, corn, hogs, even all the way down to cattle and wheat and sugar. Prices that are up significantly across the board. This has been a component of the production cost inflation that we've seen that I do think will find its way into the consumer channel and in prices. Obviously, you're paying more for a lot of these things at the grocery store already. So we're seeing cost inflation at the consumer level. And I think it's going to persist, again, not necessarily at levels that we're seeing right now, but these things, will take time to kind of work themselves through and go back down again. Here's a quick look at lumber. We have made paid a lot of attention to lumber, and we were $1,700 per thousand board feet, which is absolutely amazing to see that. But as quick as they rise, they also fall, and so while we're not necessarily back at trend line, we've seen a huge reversal in lumber. So again, to the notion that several months ago we were worried about all of these kind of hard commodities and industrial commodities going up fairly rapidly, we figured that they would come down, that there's a kind of a law of large numbers that kind of prevents them from hanging up there. But not only have we seen that rate of gain decelerate considerably, we've actually seen this outright reversal, which is actually fairly dramatic. So after looking at all of that data, and a lot of what we looked at was U.S. based, here's a quick check from BlackRock on some estimates looking ahead on the global scene. And you can see the trend lines looking up after a reversal and contraction due to the pandemic. You can see as we transition from 2021, and this data is probably all from, it looks like the first quarter, and as if you keep tracking into 2023, you can see, China rate of gain looking to improve, but also not only the U.S., but also the Euro area and Japan. And these are areas that are struggling a little bit to kind of get out of their own shadow. Obviously, Japan on the eve of the Olympics is dealing with a surge in cases and kind of a national emergency, so to speak. And so everyone's worried about not only the Delta variant, but there's now a new Lambda strain that people are beginning to talk about. And so, this is kind of a general consensus, but again, it's the backdrop of all of this is positive. Here's manufacturing production. Again, manufacturing's been strong coming out of the gate, out of the trough of the pandemic. We've had a little bit of a hiccup, but the trend lines are positive. We're not back up necessarily where we were pre-pandemic, but we're trending that way. And if you look at capacity utilization, a lot of this, and this indicator right here, and I put this in here specifically because it's automotive, and we've seen a lot of the automotive manufacturers talk about curtailments in production because of the lack of chips, semiconductors, and whatnot. So we see capacity utilization going down because of these supply choke points, which in turn is driving the demand for not only new cars, but especially used cars up very, very high. Here's the Philly Fed manufacturing capital spending expectations. And this is a regional survey, and I'm going to run a couple in parallel because we just got two data points from two different surveys from two different Federal Reserve regions over the last week. This just happens to be CapEx for Philly Fed. Again, trending higher. These are expectations. So again, the backdrop is positive. Companies feeling a little bit more confident to loosen up their purse strings to make investments in their business. Here's the Empire State, which is in the New York Fed District, and then the Philly Fed. And again, it tells the same story. These are the same indicators, but in two different Fed regions. And you can see the gyrations are obviously very similar. These are both up in the Northeast, but trending higher, maybe the delivery times coming off just a little bit in each of these areas, at least off their peaks, but they're still relatively high. Here's a quick look, and again, in the Empire State and the Philly Fed, prices paid chart looks very similar. They're off their peaks, but they're still extraordinarily high. And then down on the bottom, which I think is really impactful here, is the survey of respondents in each of these Fed districts are saying that they are receiving prices. I mean, and this particular indicator shows that not only are they paying price increases, but they're also receiving them on the back end and getting price increases as evidence of pricing power in the marketplace. Quick look at unemployment. We've got the downward trend overall in initial claims for unemployment benefits. These include a little bit of the pandemic unemployment assistance initial claims, but we've kind of flattened out here. So the labor market, if you look at initial claims overall, basically the trend line is kind of flattened, but it's still edging down. So good news on the labor front. And then on the right-hand side, we got weekly consumer comfort. And while I think the inflation numbers and inflation expectations, are building into the psyche of the average American consumer, overall consumer comfort is much higher than it was even at the beginning of the year, even if it has come down. So obviously we want the consumers to be confident. We've seen the consumer confidence numbers elsewhere in the chart pack look relatively strong. So again, this number is okay. We want to monitor it, but good for now. This is a quick look at corporate tax receipts. And in hindsight, I should have blown this chart up a little bit more so you could see it. But I think the red line is clear enough to not worry about what the actual numbers are, but just look at the trend line. So the bottom line is that profitability at the corporate level, not necessarily small business, but at the corporate level, is looking relatively strong, and as a result, tax receipts are going up. And we see this kind of trend line also at the municipal sector for tax receipts, that in state and local governments that are actually doing a lot better than people had expected. Now we get into some of the market-related stuff. You can see in the black line is the S&P 500, and in the blue line here over really the last week, I mean, we've seen this emergence of what I'll call capital strength. These are strong balance sheet companies and those that perform better than weak balance sheet companies, and we begin to see a little bit of a bifurcation of sorts. We've seen value really take the reins from growth, but that gap, year to date is kind of narrowed a little bit. We've just seen little gyrations in leadership over the last several months. Here's a quick look at valuation, and first draw your attention to the upper left-hand corner, which is a forward price to earnings ratio. And then what you see below that, which is roughly 16.5, is that orange line, which represents the average price to earnings ratio since 1995. And so clearly we're well above that, even though valuations have kind of attenuated their rise a little bit. Then down below, you see earnings estimates in that dark blue line, which continue to move higher. And then the rate of change in those earnings estimates, which is in that lighter blue. And obviously those have moved higher. That's had an impact on these multiples. And then in the upper right-hand side, what you're looking at is these various indicators and where they sit relative to their 30-year average. And you can see based on all of that data, except for the earnings yield of the index, which is basically dividends divided by the index price, and then you subtract out the corporate triple B yield on that, and you get to a point where we're fairly low on that. So that's the only indicator amongst the ones in this table in the upper right that really suggests that we're not overvalued necessarily, even though multiples have kind of come down just ever so slightly. But the rest of it does show that the market is a little stretched. Here's the S&P 500 looking at just the top 5 stocks as a percentage weight. And again, the S&P 500 is a market capitalization weighted index. So, companies like Apple have a really outsized weight in the index. And you can see if you take the top 5, which Apple is a part of, they account for 22.5% of the index. And so, the big stocks still matter a lot to S&P 500 performance. And then, in fact, on the right-hand side, you can look at in the light shaded blue, you can see the S&P 500 index overall. And in that kind of that medium shade blue, or that aqua, perhaps, you see, the S&P 500, if you subtract out all of these top 5 stocks, and then you see the top 5 stocks in that dark blue, and you can see the influence that they still have on the index, even though we have much greater breadth in this market move than we did last year. Here's a quick look at the Russell 1000 value versus growth. And this is what I was talking about a second ago. So we had, as we were tracking through the end of last year, again, the market was really dominated by the large company stocks and a lot of technology stocks. And then we saw at the end of the year kind of this rotation, this a clear signal that we were entering in a new economic cycle. And the cyclically exposed stocks began to outperform, and those are the value stocks that you see in the dark blue. And growth really kind of took a back seat, but you can see, as I just mentioned a minute ago, that gap is kind of narrowed, and we see kind of this resurgence of some sort by the growth stocks relative to value. But I still think that there's a kind of a secular play in the value side as the cyclical recovery continues to take root. Here's a quick look of valuations across the world. So the dark blue is the S&P 500 valuations, and then you look at that aqua color, and that represents the EFA, which is a kind of a broad indicator of international. And then in that kind of amber orangish color, you see the emerging markets. And so what that tells us, and as I mentioned in some of these conversations here recently, international markets, and especially emerging markets, have a lot more value. And they tend to perform, at least emerging markets for sure, tends to perform better when the dollar is moving lower. We've seen positive trends in performance in all of these categories year to date. But we haven't seen as much performance coming out of the emerging market sector. But clearly the international markets have better value at this juncture than the U.S. market does. So we want to have some exposure there. Here's a quick look at the 10-year Treasury. A lot has been made over the fact that with inflation moving higher, 10-year Treasury yields, which would normally move positively in response to inflation, are actually going the other way. It's a very interesting dynamic. We do seem to be holding up against that 200-day moving average, which is that red line. And, if you break that, then there's a risk that those rates could go lower. But what these rates are clearly telling us is that market feels like this inflation is transitory. I think in some respects it may be beginning to read in perhaps the risk of having earnings growth and economic growth numbers kind of decelerate, while even remaining positive, but just decelerating from the rate that we've seen here over the last couple of quarters. And here is an indicator of the 10-year Treasury minus the 2-year Treasury. This is what is known as the 10-to-2 spread. And clearly, as I just showed you, the 10-year Treasury yield is moving down, while at the same time, shorter term rates, really don't have a lot farther to go. We know the Fed is holding, overnight rates, essentially, Fed funds at zero. So you could go lower than that empirically, but practically speaking, the Fed's not going to do that. But short-term rates are really low. And so what we've seen is a flattening in the yield curve. And so I will tell you, based on this chart, looking at kind of the pinkish areas, which represent recessions, that you tend to see a flattening in the curve, and oftentimes you will see a negative yield curve, which you saw back in the late 80s, you saw in basically 2000, you saw it again in 2007, in advance of those last three recessions, and you didn't necessarily see it in advance of the 2020 recession, although 2020 was unique in that it was really driven by the pandemic and this forced shutdown. But you clearly saw and can see here a correlation between flattening spreads and recessions. And so where we are now, we've actually flattened, but frankly, we're nowhere near a level that I think we should be concerned about in any kind of recession at this point. And even though it's come up in erstwhile conversation, I think the data here shows that it's not something that we need to be just overtly concerned about right now. Quick look at high yields, and with these low rates and with the extreme optimism that surrounds the credit market right now, again, the expectations of a major credit problem amongst corporate issues has really kind of evaporated. There's a lot of optimism out there and a confidence level that these bonds are going to be money good, even though they might be issued by more speculative issuers. But we've seen a lot of issuance because rates are low and people are trying to refinance, which is very much at play here in this right-hand chart, which shows you in that light blue area that the overwhelming majority of the increase in issuance has been related to refinancing. And we've also seen a rise in high yield issuance related to mergers and acquisitions. So a lot of activity in the high yield market, which is driving increased supply. But spreads are really, really tight right now. And the last slide that I have is something that kind of, caters to what's been in the news a lot lately. And it's been this whole infrastructure bill spending. Again, I'm not making a political comment. I'm just highlighting something I came across in Bloomberg over the last week, that there is actually a real no kidding need to spend money on infrastructure. And this chart tells you, on the left-hand side, it's where you're more likely to drive across a bad highway bridge. And the states that have that percentage, that's pretty scary in some respects, that we have bridges, if you were in West Virginia, that 14% of the bridges are, rated structurally deficient. That's not something that gives me a lot of confidence, but it also drives a demand for this infrastructure bill, but a smart bill, one that's not just throwing good money after bad projects, but actually making investment, not spending. And you can see on the right-hand side from this graphic from Bloomberg some of the states that have perhaps some of the higher concentrations of bridge problems. And I think as we all kind of lament, and be sad about what's happened in Miami with that, with the Southside condo collapsing, it just drives the point home that, I think there is a place for smart infrastructure spending without all the pork barrel projects. And I guess my own kind of nonpartisan hope is that we reach some compromise that, perhaps might address this particular issue right here. That's all of the charts for this week. I hope you've enjoyed it. On behalf of the entire team at BKA Wealth, really appreciate your listening to this, and hope you share it with your friends and colleagues. And please feel free to reach out to us at the information provided. We'd love to hear from you. Have a great week. a safe week, and we look forward to talking to you again soon. Take care.